policy as appropriate for the near term. That means, I'm not sure, near term might be a day, a month, 2 or 3 months, but near term is not medium term or long term. And my feeling is that, again, everything else being equal, interest rates will continue to rise. JB Weir do a daily commentary, which I get a copy of. Their outlook is for an increase of 25 basis points in November and then an increase of 75 basis points throughout 2011. If so, that'll put home loan interest rates at around 8.5%. And for investors, the important point to note here is that I would be doing my number crunching on the basis of interest rates being around 8% this year, leading to 8.5% next year, in weighing up what is the right thing for you to be doing. In summary, as far as interest rates go, as interest rates go up, it means that the cost of meeting those debt repayments it also goes up. Higher interest therefore means higher loan repayments, pretty simple. As interest rates go up, it means people can buy less house for their dollar because more of their dollars are gobbled up in interest repayments. On that basis, rising interest rates tends to put a wet blanket or stifles housing demand. The biggest impact on that housing demand is on the first home buyer market because they are the most marginalised when it comes to affordability. Those people who are already in the market, who have equity in their homes, are less impacted by increases in interest rates, but the first home owner market certainly is not in that boat. Higher interest rates, particularly the cash rate, make Aussie bonds more attractive for overseas investors. To buy Aussie bonds, they've got to buy Australian dollars. That puts more demand in the Australian dollar market. There's only so much supply, and that means that our Australian dollar appreciates in value, and that's bad news for our exporters because it means they're less competitive. Again, higher interest rates looking into the future. If we jump on the JB Weir expectation, another interest rate increase this year, 25 basis points, and potentially 3 increases next year, 75 basis points. Interesting, and as investors, we need to build this into our outlook for our investments going forward. You may have seen the announcement from the New South Wales Treasurer about how they have introduced some stamp duty savings for investors and home buyers in New South Wales. And it's worthwhile spending a few minutes now looking over these changes and how they're likely to impact the New South Wales property market. Remember that New South Wales is the engine room for the Australian property market. What happens in New South Wales tends to filter out to the rest of the country. So if New South Wales has a very strong housing market, that means that it sets a favourable direction or scope for the rest of Australia. They're calling it their New South Wales Home Builders Bonus. And if you sign on before any construction has started, you will pay a 0 stamp duty. There is a limit, $600,000 for a home, $400,000 for land, and that means you can save up to $22,490. Clearly, this is an incentive to stimulate the housing market. It's good news for developers, and it's good news for people with development sites, investors with development sites, because that will mean that your site is more attractive because developers will be wanting to get a multi-family site and are willing to pay more for it on the basis of the stimulus that will come from people getting this freebie off the government. That's for pre-construction. If you're looking at under construction, the stamp duty saving is still there, but it is cut by 25%, and the value limit is still $600,000. That means a stamp duty saving of up to $5,623. Personally, I don't think that's enough of an incentive to make someone really jump and go and do something. Certainly the pre-construction incentive is there, $600K for a home, $400K for land, but the incentive for something that's already under construction is less so, and that's unlikely to have a major impact. There were 2 parties nominated that would be the chief beneficiaries of this. I mean, investors can still profit, but the chief beneficiaries will be first home buyers. Not only will they get access to the savings aforementioned, but they can also get their $7,000 grant on top of it. And the second people that we're talking about here are empty nesters. Very interesting social policy here. If you have a McMansion, you're able to sell your McMansion and buy a downsized home and avoid the stamp duty on that downsized home if you fall within the limitations of the concessions. What does this mean? Well, it means that New South Wales State Government hopes that a lot of land is opened up by baby boomers or people coming into baby boomer retirement age who have these large homes. These large homes can then be sold back into the market instead of these people sitting on them and hatching them like eggs. It is very good social policy, I believe. It encourages people to make a decision. The question is, are the empty nesters willing to leave the nest just yet, or do they believe they would rather live in the same area with the doctors and their friends and the people that they know? So the key here will be for new housing supply in those areas where the baby boomers have squirreled away their property to exist, so people can move home without having to move area. I'm a bit worried about this policy in some ways because it does not solve the planning red tape at a council level. Yes, the government is putting incentives out there, but if it takes a developer 18 months to get something across the line, there is a lag effect between now and when this policy will start to impact. It may be that if the Australian economy continues to remain solid, that this particular policy will lead into the next reasonably large increase in house prices as we have that lag effect take into consideration. Developers will be happy about this. They're probably likely to take some speculative decisions about buying property, but we're not going to see the real fruit of this potentially until some time down the track, bearing in mind that to take advantage of these savings you almost have to pre-buy. But the release of that housing may not be until sort of 12 to 14 months down the track. The impact then of the home builders bonus, if you like, in New South Wales is that, look, throwing money at people is proven as far as a stimulus impact. We saw it with the first homeowners grant, we saw it with the Rudd government boost. When you throw money at people and encourage them to buy houses, people do it. And as they do it, it causes demand to increase above supply and prices go up. There is no reason to expect otherwise in this case. Secondly, as I've mentioned, a grant of this nature will increase the value of the potential development sites. And as investors, we could do quite well to be ahead of the curve here and try and identify these sites in key areas. And if you've got the financial wherewithal to be able to lock them away, because I think they will now outperform the general market, particularly in New South Wales as far as housing returns go. By putting a cap of $600,000 on the stamp duty, it also places a ceiling on property values, because once you get above $6,000, the incentive is gone. So this $600,000 ceiling now becomes effectively, or a limit becomes a ceiling in the housing market. Now, you're going to look at me and say you can't buy much in New South Wales for $600,000, particularly in the Sydney metro area, and I agree. This will force developers to build smaller units and be a little bit more basic in what they put in them, but trust me, the developers will evolve pretty quickly, and I think it could work out pretty well. Again, there'll be a bit of a lag effect though. When you put a grant out there, it brings forward demand, which means that people who are interested in buying leave renting aside or sell their home, and that just means that there will be an impact in demand and a stimulus impact on demand as well. Finally, in regards to this particular incentive, it will shift focus away from second-hand homes, particularly smaller second-hand homes that don't have any development potential, because people would rather buy a new home with a stamp duty saving than a second-hand home with no stamp duty saving. So bear in mind, if you are looking for growth investments, your smaller property on smaller blocks of land are not necessarily going to be benefiting from this announcement. It's not all good news in New South Wales though. The left hand give, but the right hand takes away. The New South Wales government has put this new ad valorem fee on. It's not a tax, it's a fee. Yep, looks like a tax, walks like a tax, smells like a tax, it's a fee. No, it's a tax by another name. At the moment, you pay $190 every time you transfer property. This is going to increase. If you have a property less than $500,000, there's no change, but between $500K and $1 million, it's 0.25%. Over $500K and greater than $1 million, $1,000 plus 0.25 of a percent over $1 million. Now, what this basically means for us as investors is that very little. It's just the government making a basic grab for money, and they're doing it so that it's a small enough amount that people aren't really going to notice, but it will add millions and tens of millions, potentially hundreds of millions of dollars to their budget. I'm not necessarily against this. I just don't know whether this is the best way to do it. Time now to talk about the resources super profit tax. Clearly a Rudd government announcement of recent times that has caused a lot of consternation amongst people. Interestingly enough, you'd be surprised to know that people are not arguing about the need for reform. Indeed, the miners, etc., are happy to see us move towards